Here in the UK, everyday people have more than £500 billion invested in stocks and shares ISAs, and they're putting their hard-earned cash to work to help build wealth and reach their financial goals. And it's not that surprising, because history shows that despite the ups and downs of stock markets, over the long term, returns on shares have beaten cash held in savings accounts, where low interest rates and inflation make growing your cash an uphill battle. The good news is that today, getting started with investing is easier than ever. Long gone are the days when investing was only for the wealthy and their pinstriped stockbrokers. With today's app-based investing, you can set up and run an entire investment portfolio from the phone in your pocket. You don't need to be rich, and you don't need lots of investment knowledge. That's not to say that making money from investing is easy. This is your life savings, and the decisions you make have big, long-term consequences. But the UK government wants more of us to invest to build financial security, so it's by no means a niche activity. The big question is, where do you start? Well, hi, I'm Gary, and I'm with Moneyfarm to talk you through the basics of investing, so you've got all the information you need to become an investor yourself. Let's start at the beginning. What is investing? Investing is about sending your money off to work so it builds wealth on your behalf. You buy investments like shares with the aim that they'll grow in value, so when you sell them, you have more money than you started with. But hang on a minute, isn't investing risky? Well, all investments do come with some degree of risk, because they can go down in value as well as up. And this means that you could end up with less money than you started with. But the level of risk depends on the investments you choose and the approach you take. Basically, it's about taking calculated risks that you're comfortable with and that are right for your circumstances, rather than reckless, launch yourself off a mountain in a wingsuit with no experience type risks. That said, there are some key things you can do to minimize investment risk. The first thing is to get a hold of the relationship between risk and return, which says that the more risk you take, the bigger the potential returns, and also the bigger the potential to lose some money. Different investments come with different levels of risk, but you can stay in control by choosing those that match your risk appetite. The second thing is understanding the importance of diversification. Rather than investing in a single share, which means all your money is tied to the fortunes of one company, successful investors diversify, which means they buy a range of investments so that if some do badly, others compensate. In other words, they don't put all their eggs in one basket. The third thing is to think long term. When investing, you shouldn't think of tomorrow or next week, but 3 to 5 years from now, because when you're in for the long haul, you give your investments time to regain potential lost ground that could happen any day, but usually does not stick in a longer time horizon. As an example, when panic gripped the world as COVID hit in early 2020, markets dropped at record speeds and shares tumbled by more than 30% in a few weeks. But as government stepped in, they bounced back very quickly, which meant that the people that sold at the bottom were left scrambling. Let's say you want to start investing. What can you invest in? Well, there are different types of investments for UK investors. First up, there's shares, otherwise known as equities or stocks, which are what most people associate with investing. When you invest in shares, you're buying a tiny piece of a company, which makes you a partial owner in that company. This means that if the company grows in value or it pays out some of its profits in dividends, you'll benefit. On the other hand, if the company doesn't do very well, your shares may drop in value. Then you have bonds, which means you are lending your money to a company or a government for a set term. In return for the loan, they agree to pay you interest, and at the end of the term, you should get your money back. Bonds are typically considered less risky than shares, and their returns are more predictable. And then there's funds, which are a simple way for beginner investors to get started and build a diversified investment portfolio. Funds are basically a bundle of investments that are packaged up so you can buy them all in one go. They come in all shapes and sizes, from ETFs that aim to mirror the performance of an index such as the FTSE 100 or the Nasdaq, to mutual funds that are run by a professional fund manager who picks investments with the aim of outperforming a benchmark. Through funds, you can invest in everything from big US tech giants to Chinese companies to familiar UK brands. Or you can pick funds that invest in gold or sectors like healthcare or themes like clean energy. But how do I actually start investing as a beginner? Well, before parting with any money, it's sensible to set some goals and have a plan of action. One way to start is by asking yourself some key questions, such as, what are my investment goals? Think about what you're investing for and when you'll need the money, because this will influence your investment choices. If it's far in the future, like for retirement or a small child's university fund, you may feel comfortable to take on more investment risk because you'll have longer to recover any losses. On the other hand, if you need the money in 3 years to buy a house, you might be better off investing in a savings account or something like that. Then you should ask yourself, what is my risk tolerance? What kind of risk can you afford to take with your money, and how much can you cope with taking? Some people love the roller coaster of volatile markets, while others feel sick. So this thinking should be your starting point for your plan. And after that, you can plan your mix of investments. But to avoid putting all your eggs in one basket, you should think about the spread of investments you want between shares, funds, etc. But also between regions, for example, UK or emerging market shares, and sectors like tech, banking, or energy. But considering that most people have no clue or expertise to plan their mix of investments and review them regularly, is there another option? Thankfully, some investment platforms like Moneyfarm allow you to buy ready-made, professionally managed investment portfolios that match your goals and risk profiles, so you can be sure you are investing in things that make sense. Regardless of going DIY or using ready-made portfolios, you'll need a brokerage account. And here in the UK, most investors start with a stocks and shares ISA, because these allow you to get an annual tax-free allowance, which means all the investments in your ISA grow free from capital gains or income tax. But if you've maxed out allowances across ISAs and pensions, then there are still the straightforward investment accounts. When you start investing, there are a couple of things you need to think about. The first one is cost. There are charges and fees for all investments, but some are more expensive than others. For most people, the best option is to invest with ETFs, which are great for beginners, as we spoke about in this video you can find on the channel. Besides cost, you should also think about starting as early as possible to maximize gains. If you're young and you start right away, you can exploit the power of compounding, the phenomenon where your investment returns make returns of their own. As an example, let's say you start with an initial investment of £10,000 and then add £250 a month for 30 years. You'd have invested £100,000 of your own money. But if your investments grew at an average annual rate of 4.6%, you'd end up with £230,000. That's the power of compounding. This, of course, is just an estimate, and the actual amount you'd get would depend on how your investments performed over time and other factors such as fees. But still, the numbers don't lie, especially considering that if you start later, the impact of compounding is way less, which means you have to invest much more of your own cash. So there you have it, your beginner's guide to investing. If you like this video, please subscribe to the channel and check the description for more information about Moneyfarm and how to get started investing today.